Wes, very good to see you. Today, we're going to talk through three financial planning and investment opportunities in a down market. I'm so glad you have time today because things have just been volatile, right? Now, before we get into the strategies, of course, we've seen the biggest two-day wipeout in history. The market lost $6.6 trillion at one point. And I do want to talk about something that you and I have touched on before, which is the concentration risk that we're seeing in the market. 80% of the market's movement due to only 10 stocks. To see this in a different light, this is a look at the S&P's 3-month performance. Again, the Mag 7 at one point had lost $2 trillion alone. So what should we keep in mind when we see this much red on the board?
Well, just on its surface, if we're buying an S&P 500 index fund, many investors think, oh, that's all I need to do is just buy that one fund, have exposure to 500 companies. And while it's true that you are diversified amongst companies, the index itself isn't so diversified when we factor in how it actually operates, right? So the largest companies with the biggest market caps carry the greatest weighting, whether that's good or bad. And so in years like, say, 2021, when the market, if you can recall, just essentially went straight up, you could really benefit from those larger companies just by holding the index fund itself. But in years where those companies sell off and you have a correction in, say, tech stocks, those companies are dragging down the entire index. So it's a reminder to all investors that diversification above and beyond just an S&P 500 index fund is really the smart thing to do, whether that's perhaps being with what we call a more equal weight across the S&P 500, where the other companies have a bigger exposure and contribution to your investment portfolio. And then also looking outside of U.S. stocks, especially U.S. investors, we find ourselves with that home country bias, which is easy to do. But with no international exposure or not enough, you're not going to benefit from at least as of right now in the recording here, that we've got international stocks plus 14% on the year. So obviously that can help offset some of the negativity we've seen in the S&P 500 with some of these tech companies.
Really good points there. All right, so now let's get into some of these strategies. Number one, put your cash to work. I think a lot of people feel like it may be safer to hide all of their cash under the mattress right now, but we do need to keep in mind that if we do that, it really can compromise your ability to build wealth.
Absolutely. And all investors, it's natural to say, oh, the market, when it was at an all-time high, you're keeping cash on the sidelines, waiting for an opportunity to actually get it to work. But when the market sells off, that fear takes over and it's difficult to actually do it. So be sure that if you've got money on the sidelines, it's above and beyond what you need in your cash reserve. There's no reason not to get that to work, because if you're looking for an opportunity for the long term, buying in at lower points and certainly riding it back up is certainly better than just sitting there earning a fixed rate on the sidelines.
You getting your windows washed right now, Wes?
Very much so.
That's good. Clean windows are also important in a down market. Let's hop over, though, to tax loss harvesting. Can you explain how this works, please?
It is an opportunity where, let's say if you've got, when the market sells off, you've got maybe some winners in your portfolio, but you've got some positions that are at a loss. You can sell off some of those to help offset that taxable event. And even if you have a loss from that event, you can carry that forward. So up to $3,000 per year. But it's something that we've been doing with our clients to, at least from a, again, strategic standpoint, do something in a down market where you can have a benefit later. And that's selling off some winners along with some losers and rebalancing your portfolio for the longer term.
And can you explain why a Roth conversion also makes more sense in a down market?
I love this play, doing a Roth conversion in a down market. Again, it's about opportunity. There's always opportunities in down markets, but when you're taking money from a pre-tax account like an IRA and you're converting over to a Roth IRA, a tax-exempt account, then that recovery is happening in a tax-free account, which is great. And it's a wonderful thing for later in your retirement when you're looking at distribution strategies and where to pull money from, or maybe inheriting money. That money is going to be way more tax friendly than just keeping it in a tax deferred account.
Okay, real quick, just because there he is. I love it. Cleaning the windows. I've always thought that would be a fun job. I get a lot of satisfaction from just seeing things get cleaner. So
it's like
really important, just as important. Yeah. These strategies, though, Wes, crucial and also bring such peace of mind when we see such volatility. So if somebody wants to talk through any of the strategies that we have discussed, how can they get a hold of you?
You can reach us by phone, 919-322-4113, or shoot us a message, info@patriotwealthnc.com.
Great. Wes, thanks for your time today.
Thank you.